In financial year 2018, the revenues of Google India was 9,937 crores, and in FY19 as compared to FY18, the revenues dropped down to 4,149 crores, which is a shocking 55.5% decline. Let us find out the reason why. Hi, my name is Ramanujam Narayan. I have more than 15 plus years of corporate experience and I am considered to be a global gap expert. I have trained and transformed more than 1000 finance professionals in my life. Now, all of us would be wondering, what is Google India's business model? Google India's business model is threefold. One, it basically provides ad related campaign. Whatever Google AdWords you do, it is a direct competitor of Facebook. That is one of the ad revenues what they have. The second revenue is basically on account of IT services what they provided to their parent company. And the third set of services is IND AS, which is Information Technology Enabled Services. These are the three business models that Google India has as an organization. Google India has reported this change on account of implementation of IND AS 115. My goodness, Ramanujam, how can IND AS 115 reduce the revenue to this extent of a particular company? Let's look at that. Prior to IND AS 115, when Google India was following Indian GAAP, they were accounting this particular revenue on account of ad space, right? Based on gross method. Now, what does that mean? That means whenever an advertiser buys a particular space from Google India does not have a direct platform, right? Google India has to go to their parent company and purchase that space. Now, it's a business model. It has got nothing to do with accounting, right? In my life, I always say to every finance professional that every accounting transaction has got a commercial substance. All of you have to realize this, right? Now, what was the commercial substance in it? Google India does not have any entrepreneur risk in this particular transaction, right? They only purchase the inventory space of advertisement and they give it to their customers, right? Now, in Indian GAAP, there was no particular literature which was stopping you from doing the gross accounting. What do you mean by gross accounting? Whatever revenues they used to get from their customer, they used to take it as revenue. Whatever cost they were paying it to their parent company, that they were taking it as cost of revenue. What does that mean? That means that the revenue is disclosed as a top line and the cost is basically being disclosed as cost. That was an Indian GAAP accounting which was being followed. Now, when I do gross accounting, I am saying that Google India was a principal in this transaction. Now, on one side, in the accounting books, I am saying that I am a principal. Now, the case study of Google India is actually very famous as far as tax laws is concerned. Since the year 2014-15, the tax authorities have been squashing notices to Google India that whatever space they have taken from their parent company tantamounts to royalty and it is subject to tax. Now, counter to that, Google India says that we are only an ad agency who purchase the space and give it to their customer. So there is a contradictory view as far as accounts is concerned and as far as tax is concerned. Now, actually speaking, IND AS puts a rest or solves this particular issue which Google India is facing, because IND AS says very clearly that Google India is actually an agent in this transaction, because for determining whether a particular company is a principal or agent, there are three criteria. All of you should take your pen and paper and note this down. Criteria number one, whether a particular company has an inventory risk or no. In this case, Google India does not have any inventory risk. Criteria number two, whether a particular company has got any pricing risk. In this case, the pricing is decided by the Singapore entity, which is the parent of Google India. Google India does not establish any prices. Criteria number three, whether the credit risk is there with Google India or the parent company. In this case, the space is directly purchased from India and the credit risk goes to the parent company directly. The space is owned by the Singapore entity. By virtue of this, it got concluded that under IND AS 115, Google India can follow only net accounting. What does that mean? That means the purchase, what they used to do from their Singapore entity, that is being netted off against the revenue what they have earned, and they can show only the net number in the P&L. What will happen on account of this? On account of this, the revenues will substantially get reduced, because the moment you do net accounting, only the net number can come in the P&L. On one side, I am saying that the accounting revenue will go down, but my tax position will get strengthened. When I say my accounting revenue is going to go down, there will not be any cost, because whatever cost used to come in the erstwhile Indian GAAP as a cost of purchase, that cost will go away and I will report only the net number. That is what is changing as far as IND AS is concerned. When I say it's a favorable position in tax, what does it mean? Now that is the same accounting what you're following in IND AS, and you can clearly tell the tax authorities that since I am following net accounting, it is not subjected to tax and it is not in the nature of royalty. Now any which ways, one thing what all of you need to notice is since 2017, this tax related issue on digital services related invoices have gone away because equalization levy has come into the picture. Now the core aspect what all of you as finance professional need to learn is triangulating all of these aspects, right? A particular transaction might be having multiple impacts on multiple sides. Now in this particular case, just imagine what is going to be the impact on bottom line because of this transaction, or what is going to be the impact on PAT. There is not going to be any impact because the moment you do net accounting instead of gross accounting, it will impact your revenues, but your bottom line stays as it is. So there is no impact on profitability. There is a super impact on tax and your revenue substantially goes down. That is what IND AS does to you. For more such compelling and interesting case studies, I am going to conduct a 3-hour breakthrough webinar to cover the practical orientation of IND AS and IFRS. Find the link for registration below, and if you have come across any case studies in your real life situation, please go ahead and drop your comments on the comment box given in the section below.